Hello everybody, and thank you for watching this video where I'm going to talk about options trading and really the basics of options. Like, what is an option? Well, an option is a contract that gives the purchaser the right but not the obligation to buy or sell a stock at a particular price, otherwise known as the strike price. Now, options differ from stocks in three main ways. First, there is a strike price. This is the price you either want the right to purchase the stock at or sell the stock at. Second, options have a multiplier, but I'll talk more on that later. And most importantly, options have an expiration. So when you purchase a stock, you can hold it indefinitely, right? There's no obligation to sell the stock. You can just sit on it. But as soon as you purchase or sell an option, you are immediately on the clock. As we all know, time stops for nothing. Choosing your expiration is critical to options success. So there are two types of options, a call option and a put option. If, by using our strategies and indicators, we determine the stock is going to go up in price, we're going to purchase a call option. And if we determine the stock is going to go down in a price, we short the stock or we'll purchase a put. If you are like me and you need some everyday example of how this works, think of it like this. Let's say you're walking down the street and you see a house that you really like for sale and it's priced at $300,000. But you don't really want to pay $300,000 right now, but you also really like the area. You like the neighborhood, you start doing your homework and the location, and after all this research, you believe this house is going to increase dramatically over the next couple years in value. And you would like to collect that equity. Well, you don't have $300,000 right now, so what can you do? Instead of buying this home for $300,000, you decide to purchase the right to buy this house within the next 2 years at the price of $300,000. And the cost of this right, or the cost of this option, will cost you just $10,000 out of pocket right now. So now you have an option contract with a strike price of $300,000 and an expiration 2 years from now. Now let's say a year and a half goes by and the house is now worth $500,000. You can still purchase this house for $300,000 because you have the contract that lets you do this. Or you can sell this option contract to someone else. Your contract is currently worth at least $200,000. Your profit is the value of your contract minus the price that you paid up front for the contract, or $190,000. But what if things didn't work out here? What if the housing market tanks and in 2 years the house is only worth $150,000? Well, in that scenario, your contract would expire worthless. You could choose to exercise your option to buy the house for $300,000. But why would you do that when the house is now worth less? You are not obligated to exercise this option, so it would instead just expire and you lose the money you spent on the contract, otherwise known as the premium. An example of a call trade in the stock options would look more like this. We're looking at SPY, and let's say SPY was trading for $300. And we think it's going to go on a bull run, which means the price is going to go up dramatically this week. So we buy an option with a strike price of $305 and an expiration, let's say 7 days from now. So we have a call option for SPY, strike of $305, expiration 7 days from now. One contract is selling for $20. But remember, with options we have a multiplier. Almost everything in options gets multiplied by 100. So the cost of this contract would be $2,000. The reason everything is multiplied by 100 is because every one contract we purchase gives us the right to purchase or sell 100 shares of a stock. Alright, we now have the right to purchase 100 shares of SPY for at a strike price of $305 between now and 7 days from now. Let's say tomorrow morning SPY opens at $310. Our contract is now already worth at least $500 more than what we purchased it for. Now, different factors come into play when we're valuing a contract option, But to keep this example simple for now, let's say it is worth this amount. We can sell this contract now and collect that $500. Or we can hold the contract if we believe SPY will continue to rise. But just know when holding an options contract, you'll quickly begin losing value every day because of a little thing known as time decay, or theta as it is known in the options world. I'll talk more on that later. So just know that every day that passes and comes closer to the expiration date, it will be losing value. Now, if you wake up tomorrow and SPY has suddenly dropped to 290, you will see that your profit and loss is now in the red. That's because the value of your option decreased. Now there is still some value in the option because there is still a chance that the stock will increase to your strike price or higher by expiration, but the chances decrease as the stock decreases in price. You have choices here. You can continue to hold and stay in your trade if you believe SPY will swing back in your favor, or you can sell now and take the value of your option and limit your losses. If you hold through after the 7 days and SPY does not reach back to your strike price or higher, the option will expire worthless, similar to our house example. You do not need to do anything if your option will expire worthless. It will simply vanish from your positions and your total loss will be the underlying price of your contract. Now, let's look at puts. This one gives people the most trouble, but if you can understand the calls concept, you should really be able to grasp this pretty quickly, because it's simply the exact opposite. We're going to flip the calls on their heads and make money when the stock is decreasing in price. This is one of the greatest benefits of learning to trade options, because this allows us to make money even in a recession, even now as the market swings from highs to lows daily. How? Well, because when you purchase a put, you are purchasing the right to sell 100 shares of the stock for your chosen strike price and by your expiration date. So let's say that we're looking at SPY again, currently trading still at $300, and we think there will be a market correction coming up, meaning we think the stock will decrease in price. So we want to purchase a put option. We purchase a put that expires 7 days from now. We choose a strike price of $295. 2 days go by and we check back in and we see SPY now trading at $275. We now hold a right to sell our 100 shares of SPY at a price point of $295, $20 more than the stock is currently trading for. Using our multiplier, our contract has a real value of $20 a share, or $2,000. Before we get into more examples, let's talk about prices and how we determine a contract's value. There are two components that make up an options contract's value: intrinsic and extrinsic value. Intrinsic value is the actual valuation of the contract. We call back to the house example from earlier. The actual value of that contract was the difference between the current value of the house of $500,000 and the discounted price that we own the option of purchasing the house at of $300,000. So the intrinsic value of that contract would be $200,000. So if we own a put option in SPY with a strike price of $300 and SPY is currently trading at $280, our contract would have an intrinsic value of $20. Remember, our options multiplier of 100, so we're looking at a minimum of $2,000 in intrinsic value. But we also own something more here, don't we? More than just this intrinsic value. So what is this extra thing, and what is it worth? We call this the extrinsic value, also known as the time value of our contract. Essentially, the contract is worth more now because of the potential for the contract to become worth more later. Knowing this, it makes sense that when we look at further out expiration dates at the same strike price, we will see that these contracts naturally cost more money. Because although they hold the same intrinsic value with the same strike prices, these further out options hold more extrinsic value or time value. The probability of the contracts becoming worth more increases. Also, because we know the further out we go, the more time value these options have, we can flip that concept on its head as well and say the closer to expiration we go, the more value our contracts lose. So let's look at Apple stock with different expirations. We see if we go a few weeks out, this call option is at this price. Now, let's look at a call option, same strike price, but with the next available expiration. Much cheaper, right? This is how time value works, and I hope that makes sense to you. Smaller accounts can purchase closer expiration contracts, but the risk of the option expiring worthless is a little higher. You'd only want to trade these closer expirations if you were going to do extremely quick trades like I do. I mean like 1 to 2 hour max, closer to 20 minutes. Get your profits and close out your position. If you get into these trades and the stock doesn't move, or it moves in the opposite direction, and you get stuck holding that trade, you will lose value quickly. If you hold an out-of-the-money option with an expiration in the next couple days, you will get hammered in time decay. I hope this video helps you to understand the concept of options and options trading, which allows you to take advantage of high-cap stocks like Amazon, Tesla, SPY, and Apple, with a lot less capital up front. Like this trade here I made with Tesla. I purchased a handful of contracts of Tesla options, which gave me the right to purchase 1,000 shares of Tesla at a discounted price. I woke up a few days later and the value of these contracts skyrocketed to make me $15,500 off of this one trade. Now I did the same thing here with Amazon. I analyzed this trade, and after determining the stock was likely to shoot up, I purchased a handful of call options on July 17th. A few days later, I was looking at another $15,000 trade. I was only able to make this kind of money by purchasing options of these high-cap stocks because the capital to do so was much less than if I were to have purchased the stocks themselves, and I mean a lot less, thousands of dollars less. That is the power of options trading, and that is why I do it. So I can take advantage of the market by keeping my risk low and my profits high. As you can imagine, there is so much more to options trading than what I can fit into one video. But with so many people interested in learning more, I thought I would start with the basics of what exactly it is that we are trading. If you are interested in learning more, we are still offering our course that will teach you everything you need to know about options trading, including my trading strategies and chart patterns, as well as access to my exclusive trading group where I shout out my trades every day, what stock I'm trading, what entry, and my exit points for just $5.95, about a third of what my course is worth. Look at some of these other trading group prices. Investor Underground, $1,900. True Trader, $1,200. Live Trader, their discounted price of $900. And that doesn't include all the gimmicks once you enter those groups. My course, access to me and my trading group, and my strategies where you can learn how to make these kinds of profits for half the price of a new iPhone. Stop burning your hard-earned money on material things and start investing in your education and your financial future now. Just go to tradingwithjason.com and begin your journey to financial freedom today. I look forward to seeing you all in my trading group.